Should you use trailing stops? Hi, it's Charlie giving you this week's video here. And this was a topic of request from a trader. There are different, of course, ways to trade the financial markets. As far as trade management is concerned, you can use targets or you can use trailing stops. So this video is really about trailing stops. And so I've just got an S&P contract up here on the daily time frame to give us our first example. And because it depends, the answer is which one's best, and that's essentially what someone was asking me. It really comes down to a trader's personal style. You can either have a target, get in down here, and then you have a price target, might be up against a prior high up here or whatever. The risk of coming out at a target is that the market carries on going. Now, okay, so then you could use a trailing stop. And one way of using a trailing stop would be to trail it after every pullback, and then market goes to a new high. You move the stop loss up to that new swing low. But in this instance, therefore, we've had a pullback here. Market goes to a new high, so then you would move the stop up to here, only to then get stopped out here anyway. So what my point is, there's no magic solution to whether you use trailing stops or you use targets. There's not really a, oh, one is better than the other necessarily. It's just a case of what is better for you, what you prefer as a trader. So because there's going to be times like that where you've just ended up getting stopped out, but you might have had a good run anyway, and so then you just move on to your next trade. You can't. It's very difficult to have a trailing stop mechanism which is going to account for everything, because if you had a larger trailing stop in this instance, then you'd have still been in all the way up, and until maybe this larger retracement here. But then in other instances, that means that if it rolled over sooner, then you'd make nothing at all. So, and there is no, one size fits all. It's about what's right for you. So you can use a trailing stop system in so many different ways. You can trail it up to the last swing lows, as I've just sort of highlighted here. All right, you might have got stopped out down there, but if you got into a new trade through here, then you'd have trailed that all the way up until made a new high here, so you'd have got stopped out maybe there, if I've not missed anything here. That's just one way of doing it. You can use moving averages and a close below something like a 10-day moving average, or a close below the 20-day moving average. So and just say, well, I'll use that as an exit. Or you could use something like just a 2-bar trailing stop if you're going to be really aggressive, and literally have a stop 2 bars behind the current bar, and then it just tracks 2 bars behind. Or you could have a percentage trailing stop. You could have a trailing stop based on average true range. So if you want to trade with those things, the best way is to go and test them, and test what, based on your style and your strategy, your approach to the market, what would suit you best. So the wider the stops will keep you in the bigger trends for longer, but at the same time, you'll have a lot of frustrations with those ones as well, because they may actually ultimately make you more money because they'll get you in the mega trends. But there'll be plenty of moves which just roll back over, and then those wider stops will just get you a straight stop out, whereas an aggressive stop will have still yielded you maybe some form of profit. So again, it comes down to the individual. If I go to a different chart here and go to something like the dollar yen, which has been, of course, of interest just lately, but if I just take it back just a short time ago, just into last year, then when you're looking at sometimes the currencies, they will come over and take out the last low. So you've moved your stop up, let's say in this point here, and let's, for argument's sake, say you're waiting for the next pullback and then move to the upside before you trail your stop again, only for this to come all the way back down, take your trailing stop out because maybe you got in down here, only to then start going up again. So that's a good example of where there's no magic to this, that one style of trailing stop is going to be always better than another. Much like if we then come through here, you know, I don't know, let's say you've got in down here and you're using a more aggressive trailing stop, so a percentage below price, or you know, couple of bars back or whatever it might be. You've got your stop down here at this point. You're thinking, oh, this is all right, it's having a good run, only for it to spike down, nick you out, only to go higher. So my point is, it doesn't matter what type of trailing stop you use, there are going to be frustrations with it. Much like there would be also frustrations with targets when targets don't get hit as well. So there is no one size fits all. It's just a case of, as always, finding a middle ground, and what type, if we're looking at trailing stops, what type suits you. And the only way you're going to find that is by doing a bit of data mining and a bit of back testing of your strategy, going back through a load of setups and finding a suitable trailing stop that suits you, which maybe is not too aggressive, but at the same time maybe not too wide either. So, but again, that comes down to the individual. A wider stop would suit an individual who wants to be in these bigger trends when they develop. If you go aggressive on your stop loss, you're pretty much guaranteeing yourself that you're going to get trading stopped out most of the time more aggressively. But again, for some traders, they would rather that too. So that's my general advice there for this week on trailing stops. Backtest it and look at various ways of trailing stop, both aggressive and less aggressive, and that will give you the data that you need to then coupling that data with what you feel would sit better with you as an individual. Because at the end of the day, it doesn't matter who you are as a trader, some people are going to prefer tight trading stops, and therefore they're going to be in and out of the market relative to the time frame they're trading on that bit quicker, and make a sacrifice that they're trading a stop but they're not going to be in forever. And others are going to want a wider stop because they want to be in those mega trends. That comes down to you as an individual as to what you're comfortable with. There you go, some food for thought on trading stops for this week.